Hi class, welcome to week 1, chapter 1. We're going to be discussing the first chapter today. One thing I want to mention to you quickly, if you plan on pursuing a career in finance or continuing your education at another university, highly recommend getting one of these calculators. It's a Texas Instruments BA2+. It'll help you in a lot of calculations and stuff with investments, as well as if you ever decide to take the CFA exam. It's a requirement. You'll hear me mention this probably more than once during the semester of the CFA exam because it is becoming more prominent than your master's degree in terms of pursuing higher education in the investment management business. We won't be doing too many heavy calculations in the first chapter, but it is good to have. So, chapter 1, the investment setting. Let's begin. Okay, learning objectives. Okay. Financial assets versus real assets, we'll go over that today. Key considerations in setting investment objectives. Let's talk about like retirement planning, things like that. So for example, somebody who is 45 years old versus somebody who's 20 years old are going to have very different portfolios in terms of saving for their retirement. Because of the time horizon when they might retire, maybe liquidity concerns. What are liquidity concerns? You know, when are they able to get the money? How quick do they need cash, etc. Changes in investment strategy caused by tax law revision. Okay, different types of investments have different tax laws. The prominent one we'll hear in the media right now is about dividend tax. I believe dividend tax is somewhere around 15%. However, it used to be higher. I think during the Bush administration, second Bush administration, they reduced the dividends tax. Reducing the dividend tax makes it more attractive to receive dividends. Okay, because we don't really care about before tax returns; it's really after tax returns. So we'll get into that. Relationship between risk and return. You know, we're going to go over this in more detail, but one thing to keep in mind: what would investors prefer? The highest return at the least amount of risk, right? If you had two investments, all things being equal, and they both returned 10%, you would take the one that is perceived to be less risky, right? If you're a rational investor, okay? 3 factors that comprise the required rate of return for an investor. We'll go into that later. And career opportunities and investments. I will do my best. It's hard without a classroom of you guys here. But I'll do my best to go into as much detail as I can about pursuing a career in finance. I've been in finance, investment management for the past 7 years, and started entry level and now kind of mid-career. Also, another really important thing to keep in mind is that you must do the reading. I'm going to make these lectures here probably about 15 minutes long each for each chapter. Some might be 5 or 10 minutes longer than others, depending on the complexity of the topic. Anything covered in the chapter is valid for quiz material. Now granted, yes, because this is an online class, you can do an open book, etc., etc. What I found in these online classes is that sometimes students think they can Google their answers for the homework and for quizzes and tests and stuff like that. And it's pretty obvious to me when that happens because guess what? I can copy and paste a question into Google and see what the first result is. So if it's copy paste, it's pretty relevant and obvious to me. So I just wanted to throw that out there. You must watch these lectures and you must do the reading for each chapter. Otherwise you won't do well in this course. I just want to be really clear about that. If you do the reading and if you watch these lectures, you will be fine. I think doing this class online is a very productive way to go, and it's a topic that I can easily convey over the web. So let's go to the next slide. Okay. The investment setting, okay. Forms of investment, we'll go into details on that. The setting for investment objectives, this is the exact same slide. No, it's not. Actual considerations of required returns, what you will learn, and career opportunities and investments. This is kind of a deep slide, sorry about that. Investment defined. The commitment of current funds in anticipation of receiving a larger future flow of funds. Pretty straightforward, pretty simple. I invest $100 today, I'm expecting $110 a year from now, which would actually be a pretty decent return. Okay? Financial asset versus a real asset. That's definitely quizzable material. Financial asset is a financial claim on an asset, meaning, you're invested in something. I bought a stock, I bought a bond, I have some kind of option or other kind of trading vehicle. Versus a real asset, a real asset is something tangible. What do I mean by tangible? This desk is tangible. If I bought a pizza shop, that's tangible. If I bought a car, that's tangible. A car probably wouldn't be the best investment, but a house is a tangible investment. Real estate, things like that. Let's move on to the next slide. Okay. Forms of investments. So it goes into a little bit more detail. Financial assets, equity claims. Okay, we're calling these direct equity claims. Should be common stock, warrants, options. Indirect equity claims would be investment company shares, like a mutual fund. Why is a mutual fund considered indirect? Well, oftentimes with a mutual fund, you're not owning the individual stocks. You're owning the basket of stocks. Okay, so that's the primary difference. So by owning an S&P 500 mutual fund, you indirectly own all or most of the shares of stock in the S&P 500, as opposed to directly buying all the individual shares, which would be under direct investment. So ETFs are very similar in terms of the concept as mutual funds. So pension funds, whole life insurance, retirement accounts, all those get qualified under indirect investments. Creditor claims, so you have savings accounts, money market accounts, commercial paper, treasury bills, bonds, notes, corporate bonds. So creditor claims, what are creditor claims? Debt, right? You're owning debt. It seems kind of counterintuitive to own debt, but it's basically like, you have an IOU, right? Preferred stock and commodity futures. What are commodities? Commodities are, gold, oil, pork bellies, orange juice futures, things like that. Then going into real assets, we have office buildings, apartments, things I already mentioned. Commodities are also considered real assets. Gems, collectible art, cattle, oil, common metals. So you see a lot of commodity-related stuff under financial assets. Okay. The setting of investment objectives. Okay. So how do we set our investment objectives? Let's say I'm a financial advisor. You walk into my office and you want to know how you should be planning your portfolio, or you're just coming to me, or you want me to tell you how to plan your portfolio. Well, I want to look at risk and safety of principal. Okay. So let's say you're 20 years old and you're looking to set up your investment portfolio, right? If you're 20 years old, you have another 40, maybe 50 years until you retire, right? So you're allowed to do whatever you want, but it would be recommended that you can take more risk. You can invest in, Brazilian corporate debt. You can invest in some obscure Chinese securities that might promise a really high return. However, on the complete opposite end of the spectrum, and we might have heard stories like this during the financial crisis from around 2007 to 2010, if you're close to retirement, let's say you're 50 years old, right? I would not recommend that you get into some kind of risky investments, right? Like, for example, Facebook stock, right? If you're 50 years old, I wouldn't be betting your retirement money on how good or bad Facebook stock would do, right? Why? Because you're close to retirement and you want to be focused more on capital preservation or current income. You want to go safe, right? Now, I'm not saying you should put all your stock in only, Pepsi, Coke, Walmart, Target, names that we are pretty sure are going to disappear in the next few years, right? However, a majority of your portfolio, in that case, would be allocated to safer investments, right? Okay? Liquidity considerations, right? Now, this is going to be different for everybody, right? For a retirement account for somebody who's 20, you're not really going to have any liquidity considerations, usually, right? Because when are you going to need the money? Well, you're not going to need the money for 50 years, 40 years, 30 years, whatever. If you're 60 years old, you're going to have high liquidity concerns, right? Because you're going to need to start taking this money out, okay? Also, let's say you're 45 or 45 years old. you might be having a child getting ready to go to college. So, taking a step aside from not only retirement savings, but just general savings in the stock market, you might have higher liquidity concerns because you have a kid going off to college and you might have to pay the bill, right? And that bill is going to be, let's just say $20,000 a year, right? So you're going to have liquidity concerns at 45 because of your child going off to college, and you're going to need to take some money out. So these are all assessed on the individual level, okay? Tax factors, what kind of tax bracket do you fit in? There are some kinds of investments that we'll go into later in the semester that, like municipal bonds, you don't pay taxes on them, okay? And there's an interesting reason for that, but we'll get into that later, okay? Ease of management, do you want to be picking stocks? Do you want to be passively invested in the market? Do you want to be actively invested in the market? How often do you want to look at your portfolio? And just to give you an idea, passive investing is kind of basically just putting your money into the stock market at a passive level. It's not actively managed, meaning you're not picking stocks. You're just investing in the S&P 500. So if the S&P 500 you see on the news, or the Dow Jones, whatever, goes up 1% one day, well, your portfolio hypothetically went up 1% one day. However, you can get involved in active management either on your own or through an investment manager where they try to make bets on the market to increase your return, right? Higher risk, higher return, okay? And then retirement and estate planning, we have the next bullet point here. Just looping back to what I said before, where are you? What phase of your life are you in? What kind of assets do you have? Somebody who's 60 years old who has multi-million dollars in savings is going to have a very different risk perspective and a very different liquidity perspective than somebody who is living paycheck to paycheck at that same age. So these are all things to consider, okay? Risk and safety of principal. Okay, what factors can affect the value of your portfolio? Anything that happens during the day, right? Anything that happens during the stock market during the day, okay? New information enters the market, stream all day long. Congressional testimony by Ben Bernanke, okay? Who's Ben Bernanke? He's the head of the Fed. What does the Fed do? The Fed does multiple things, but they try to control or monitor the interest rate in the economy. Why is that important? Well, the interest rate affects everything. Think about this. You're going to buy a car, right? Or a house, okay? If your interest rate is 3% versus 6% on a $200,000 mortgage, your payment is going to be hundreds of dollars difference, And that hundreds of dollars difference could mean whether you can afford this house or you can't. During the financial crisis, a lot of people got involved in mortgages at really low interest rates, and they were able to afford those mortgages. And then these mortgages reset at a higher interest rate. But when the interest rate went higher, they were no longer able to afford the properties they were before. Okay? New information enters the market. For example, a few months ago when Steve Jobs died, the death of Steve Jobs had an impact on the Apple stock, right? I forget at the moment whether it's positive or negative, but it did have an impact on the stock. Any kind of information about the stock automatically gets priced into the value of the stock, right? I'm trying to think of another example of something going on currently that's relevant here that I can think about news. The Greek euro crisis. Is Greece going to exit the euro? What kind of impact would that have on a U.S. company? Might not have much of an impact at all, but it could have a great impact depending on the scope of their business, and which would then in turn have an impact on the price of their stock. Okay. Surprise earnings announcements. I got a good one. BlackBerry, right? I don't know how many of you guys still have the BlackBerry. I got rid of mine about a year and a half ago. They've turned it from a really innovative company with a dominant market share in smartphones to a big loser, all right? And it's not even going to be a surprise this quarter, but they're losing customers, by the thousands, okay? How is that going to affect the price of their stock? Obviously, it's going to drop, right? Here's the concept that's a little harder to get with this, is that we know that the price of BlackBerry is going to go lower, or should go lower, right? But if, let's say, all the analysts of the stock market are saying, all right, we expect BlackBerry to lose 1 million subscribers this quarter. They're going to lose 1 million subscribers this quarter, right? So, if the majority of analysts think that they're going to lose 1 million subscribers, okay, that's already priced into the stock. So when that comes true, hypothetically, and they lose 1 million subscribers, it probably won't have an effect on the stock because that was anticipated that they were going to lose 1 million subscribers, right? However, if it turns out that everyone expected them to lose 1 million subscribers, but then they only lose 500,000, that's actually a good thing for the price of the stock. That's a surprise in earnings, well, related to a surprise in earnings announcement. We don't know how that would directly affect earnings. Assuming they lose less than expected, that's going to be positive. Okay, so that would be a surprise announcement, right? On the other side, if they lose 1.5 million customers instead of the anticipated million, guess what? That actually will bring the stock down further. Okay, what other stuff will be affected in terms of risk and safety with other companies, natural disasters. Earlier this year, because of the earthquakes, there was a few earthquakes, but there was the big one last year in Japan. Hard drive prices in computers skyrocketed because of the impact of natural disasters in that region, right? So hard drives get more expensive. Basic economics will say people will buy less hard drives, right? Also, anything to do with finance, economics, legal issues, investor psychology, new scientific discoveries, politics, and war can all have an impact on your portfolio. Just getting, touching base on earthquakes, tsunamis, and floods, that, and this might sound, morbid or, taking advantage, but this does happen, right? If there is a big natural disaster, you don't always have to lose money if you're invested in that region. For example, I've heard stories about traders who invested in potato and rice futures immediately after a natural disaster, and they made a lot of money. Why would investing in potato and rice futures be, a good idea after a major natural disaster? Well, because they're what they'll feed the people in that region while they're waiting for stuff to get back online, because they're easily transportable food products. So by increasing the demand for those products, the value of those products go up, causing a profit. And you could do something like that by buying futures or something in that commodity sector. And it's kind of the same thing with oil. When the global economy is doing really well, oil will go up in price, right? When the global economy is doing poorly, it will depress oil prices and oil prices go down. So it's kind of this catch-22 with oil prices. We all want the economy to do better, but when the economy starts doing really well, oil prices go up and then no one's happy about it, right? When the economy is doing poorly, oil prices go down, but nothing else is good. The sweet spot for Americans would be if the global economy is doing poorly, but the U.S. economy is doing good, then that's where we kind of hit that sweet spot of the commodity prices are good for us and our economy is also good. But a lot of things are at play there, okay? Risk is the variability of the expected return, okay? So we'll invest in something, we'll have an expectation about how that should perform, right? But there's no guarantee, right? Again, you've heard this before, high risk, high return. High risk, high return is, attached with aggressive investors. Oil, again, is highly, variable in terms of its price and where it can go. There's so many different factors. You could have some kind of tribal fight over the pipelines in Nigeria, which seems so obscure to somebody in the U.S., but that could have an impact on oil prices globally, right? Low risk, low return. Okay, conservative investors. Bank accounts, CDs, T-bills, T-notes, T-bonds. T-bills, T-notes, T-bonds are all government securities. They are technically not risk-free, right? But they're considered to be the risk-free investment. Basically, you're betting that the U.S., if you buy T-bills, T-notes, T-bonds, it's basically a bet that you believe that when you wake up tomorrow, the U.S. government will still be here, right? Current income versus capital appreciation, okay, the trade-off. So current income is usually in the form of dividends or interest, right? You'll hear, like, when you're close to retirement, somebody might buy an interest-bearing bond in, like, Coca-Cola, right? It only might pay, you know, something really low in terms of interest, but you know Coca-Cola is good for the money, right? As opposed to an American Airlines bond, right? Which might pay 10%, but, you know, you don't know if they're going to go bankrupt for the third time in this decade or not. So that's the trade-off. Capital appreciation, not all stocks pay dividends, right? Some just, do capital appreciation. Some only appreciate, right? There are some expectations that eventually a company will pay some sort of dividend, right? Pay out money to the investors, but that's not always the case. Microsoft, only over the last few years, I think in the last 3 years, decided to pay a dividend, okay? Why would a company pay a dividend anyway? Well, the idea is that if they have extra money, and this is also the case with Apple, I think they started paying a dividend as well. If they have extra money, it's expected, and they have nothing left to, no good investments to invest in, it's expected that they'll pay that extra money out to their shareholders, right? So, capital appreciation, price gains, not income. So it's going up in price, but you're not getting any kind of money handed to you, okay? There's an increase in value, there's no cash dividends. This usually applies to high growth industries. Why would it apply to high growth industries? Well, that's because high growth industries burn a lot of cash, right? They're gonna be constantly investing a lot of, the extra money they get back into the company. But when you get so big, Apple, Microsoft, there's not as many attractive investments anymore, right? So they'll build up large piles of cash and then be expected at some point to pay that cash out, okay? Did this in reverse. Current income. Objective is income, not growth, right? So let's say McDonald's, right? I mean, do we expect a tremendous growth in the amount of McDonald's stores? I mean, they're still growing, of course, but they're not growing at a rapid rate, okay? So McDonald's is a company that would pay some kind of dividend, okay? You're not going to expect the McDonald's stock to double, right? Why? Because it has more limited growth opportunities, but they're going to pay a dividend, right? So, also, it talks about bond interest. Bonds are also have this connotation of being more safe, and that's true. When you buy a stock, you're kind of buying a piece of the company, right? You have a little piece of ownership in that company, or a large piece, depending on how much stock you bought. So the perceived value of the company changes day to day. When you buy a bond, what you're really buying is a bet that the company won't go bankrupt. Because as long as the company doesn't go bankrupt, you're going to get your semi-annual interest payments until the bond matures. When a bond matures, you get your initial investment amount back, and then you're all paid back, and that's it. So recently, I invested in Netflix bonds. Okay, it's considered higher risk. Why? Because Netflix is a growth industry, right? During my last class, I had some students really high on this idea of a Netflix bond, and some people were like, "No, I think Netflix is terrible." Okay, the Netflix bond pays about 8.5%. Let's call it between 8 and 9% interest, depending on when you bought it. Okay. Now, I wouldn't consider that a safe investment. For me, it's a safe investment, but for somebody else, I don't know if I could wholeheartedly recommend that for everybody across the board. Okay. So as long as Netflix doesn't go bankrupt, I'm going to get 8% interest a year in my investment, and I put $5,000 in there. However, if Netflix goes belly up, there's a high likelihood I won't get anything back, right? So but it's less risky than buying the stock, because the stock of Netflix, if you follow that at all, the stock has, I think it was around $250 or something crazy last summer, and now it's around $100. So we saw the price just, flip, but the bond remained stable, okay? Has some fluctuation in price in the bond, but pricing bonds is a little different. We'll get into that later in the semester, okay? Liquidity considerations. Liquidity is measured by the ability to convert an investment quickly into cash at fair market value, okay? A great example of an illiquid asset, right? The opposite of liquid would be real estate, right? How long does it take you to sell a house? 60, 90, 60, 90 days, 6 months, a year? You're not able, if you're concerned with liquidity, investing in real estate probably isn't the best idea for you because you're not able to convert that asset into cash quickly. Now, if you're buying, some normal stock that's traded every day, on the, U.S. stock exchanges, I buy shares in Dell. Regardless of what happens to the share price of Dell, I'll be able to buy it and sell it within a minute. That's how long it'll take. So that is what liquidity concerns are related to. Okay. Now, all stocks aren't liquid though. Some stocks are, highly illiquid. You can buy stocks in some really obscure foreign country, in I can buy a Chilean mining company stock that might not trade every day. If that's the case, I might put in a sell order. It might take a week to sell it because there's no buyers. And it's harder to judge the price on an illiquid asset, right? Because there's not as many buyers. So, for example, using the real estate investment again, real estate idea again, how much is your house worth? Well, you can use Zillow.com or talk to an appraiser, but you really don't know what your house is worth until you start getting offers, right? And if no one's giving offers, does that mean your house is worthless? No, but there's a bunch of other factors that go along with that. So I just want to bring that up as well. So other liquidity factors, transaction costs, how much does it cost for you to make the trade, commission, difference between bid and ask price. Okay, so when you have the bid-ask price, and the book gives some good examples. I don't have a marker right now to write on the board. If there's a high spread between the bid and ask price, meaning, if the buyer is asking for, $1 and the seller is asking for $1.50, there's a huge spread there in terms of what the buyer wants and what the seller wants, right? And when there's a big spread between the bid and ask price, that means it's likely very illiquid. Now, when the spread between the bid and ask price is tight, meaning small, that means it's highly liquid, right? Because if the buyer wants to buy the asset for $1 and the seller wants to sell the asset for $1.50, they're so far off from each other in terms of coming to a deal, right? But if they're close, then the deal will happen, right? Alternative investment opportunities with higher unusual expected returns. Arbitrage is another example. Talks about IPOs down the bottom of the screen that in hindsight were great ideas. Microsoft, Amazon, eBay. Right now they're saying in the media how the Facebook stock was a big flop. It was a big flop for investors. For Facebook, it did really well because they priced it at $38 a share. And they sold it at $38 a share. Subsequently, after Facebook sold the stock, it dropped. So Facebook got the full value. They sold their shares for $38 a share. All these investors who bought it from Facebook up until now, they are getting crushed. So for Facebook, it was actually a great IPO. They got the value they were looking for. But for the individual investor, they bought it and then it kind of tanked. So there's a difference between a successful IPO for a company and a successful IPO for the investor. So we'll also get into this stuff later in the semester as well. Okay. Short term versus long term, very straightforward. Short term is defined as 1 year or less. Intermediate is between 1 and 10 years. Long term is over 10 years. And just talking about diversification of maturity dates, you wouldn't want everything to be short term. You wouldn't want everything to be long term. You want to diversify your assets. Okay. Who has short-term perspective? Traders. Okay. Traders are, especially day traders, are going there every day and trying to just, do large volume and make small profits off large volume, right? Similar to if you're having some kind of store, right, and you're selling a slice of pizza, right? You would rather sell 100 slices at $1 a piece than 20 slices at $5 a piece, right? Technical analysis. What is technical analysis? It's using market indicators, charting, moving averages, ceiling floors, turning points. They don't, technical analysis has more to do with, historical numbers on the stock and where there's support, and a lot of more psychological, in a sense, investment style, like, oh, the stock never is below $5, so whenever it hits $5, we're going to buy it, and then, because that's usually the bottom of the stock. So we'll buy it at 5 when it hits 5, and then usually it pops up historically. So again, we'll go into that in more detail later in the semester as well. Long-term perspective. Investors have a long or longer-term perspective. Buy and hold strategy is, I know some people who were like given Disney stock when they were born, and they still have it, and it's one of those things where it's it's just going to appreciate in value hypothetically, right? Longer-term analysis, fundamental, right? Looking at growth rates in sales, market share, earnings per share, profit margins, financial statement analysis, looking at year-over-year numbers on the balance sheets, income statements, cash flow statements, looking at the health of the company, in some cases talking to management, things like that. You can look at some things on the balance sheet, income statement, and see, all right, inventories are growing on the balance sheet, right? What does that mean? Well, alone that piece of information means nothing, right? But inventories growing on the balance sheet could probably mean two things. One, they're not selling the stuff they have on their shelves, okay? Which would be the negative side of looking at higher inventories on the balance sheet. Number two, they could, let's say, it's getting close to the holidays, and they could be building up their inventory in anticipation of higher sales growth. That would be a positive indicator of higher inventories. And there's different things to look at when making those decisions and seeing a factor like that and saying, is this going to be positive or is it going to be negative? High tax brackets usually will invest more in municipal bonds, which are tax-free. Okay, I'm going to go off on a little tangent here about municipal bonds and why it's important and what does it matter that they're tax-free. Why are they tax-free? So municipal bonds are often issued by cities, states, towns, etc. I grew up in Arlington, Mass. So I don't know if Arlington, Mass has a bond, but let's say they did. They're able to offer that bond and give you the return of 5%, hypothetically, right? Now, getting a tax-free return at 5% is the same as getting a taxed return at 7%, okay? Who does that benefit? It benefits the town. They're able to offer a lower interest rate that is, because it's tax-free, it's the equivalent of actually a taxed 7 or 8% interest rate. So it allows them to compete with the private market, right? So if the town of Arlington is paying a 5% interest rate, and my Netflix bond is paying 8%, I might say, oh, well, I might go with the tax-free town of Arlington bond because equivalent, after taxes, they're actually the exact same return, okay? Real estate, you can depreciate real estate. Real estate can be a tax write-off. Mortgage payments, I don't know if you're familiar with that, are a tax write-off, so you get tax credits. I won't go into the tax shelters and Tax Relief Act of 2003, though I won't quiz you on that either. Okay? Ease of management. Okay? Two choices here, professional investment managers and do-it-yourself approach. So even buying a mutual fund would be considered professional management. Most mutual funds are actually actively managed. Remember earlier I said ETFs exchange traded funds are almost the same as mutual funds. They are, but ETFs are generally passively managed. They're matched to a benchmark. So you buy an ETF, ETFs are going to be matching the benchmark of that industry sector or overall market. Professional management is trying to pick stocks. Yeah. But when you have a investment manager involved, they're going to charge you fees. They got to eat too. So you're paying for the service of professional management in the hopes of a higher possible return. Now, does all professional management always beat the market? Absolutely not. In fact, studies have shown that professional managers, on average, underperform the market. Now, when you say on average, it's always tricky, right? Well, what does that mean, on average? The best managers will outperform the market. The majority of managers won't. So, why doesn't everyone just go passive? Well, because there are some managers who hit home runs, and people like chasing returns, okay? Retirement and estate planning. When is the best time to start a retirement plan? Today. If you don't have a retirement plan, you should start one today. If your company offers a 401k, get involved. You should be looking, a 401k, we're talking about a 401k is a defined contribution plan, or DC plan, okay? Why are DC plans, aka 401k plans, good for the company and bad for you? Well, it puts all the liability on you. They contribute, hypothetically, to your 401k, and you pick your assets. You pick the investment vehicles in that 401k. They give you some options, but you pick the excuse me, the hiccups. You pick that investment vehicle. Now, if you make bad investment decisions, your company's off the hook, right? They don't owe you anything. They already contributed to 401k. Compared to a pension plan, where the obligation is on the corporation to provide you this future benefit upon retirement. The kind of whole onus is on that company to pay you. So it's a liability for that company. That's why we're seeing this shift away from pension plans to defined contribution plans. Also, pension plans are also considered a defined benefit. Pretty easy to remember. You have a defined benefit. Your benefit is written in stone. Where a defined contribution, your contribution is written in stone, and that's it. Okay. Tax implications, compounding. We all know, I'm not going to do this on the board either, but compound interest. If we get, if we had, $10,000 and we had compound interest rate of, 10%, after 30 years, at compounding at 10% every year, that $10,000 is going to be a tremendous amount of money in 30 years. That's why they say start as early as you can with retirement planning, because of compound interest, okay? Next slide, we already talked about this, but I'll say it again. Defined benefit, great quiz questions. Specifies the amount of retirement benefit based on income and years of service. Defined benefit is AKA what? A pension plan, okay? Defined contribution requires the employee to make contributions out of each paycheck into the retirement fund. Generally, the employer will also match in some sense. Next, we're talking about inflation. What is inflation? Well, easy way to define inflation is, a can of Coke cost me 75 cents last year. This year it's 80 cents. Next year it's going to be 90 cents, right? It's kind of like the purchasing power of our dollars, right? Now, they say that it's good to have some inflation, somewhere around 2 to 4% inflation is normal, okay? When you have inflation, purchasing power falls, okay? If inflation equals 2%, then a pack of gum will cost $1.02 next year. That would be a great quiz question if I was going to ask you something. And you'll notice this, as I do the slides, I'll try to give you some hints on what kind of quiz questions I'll ask, and you'll almost get to see the answers. So it's kind of my way of seeing if you're watching these videos, okay? Measures of risk and return, calculating rate of return. Now, pardon the slide formatting here. I'm going to try to fix this for next week. But basically, Rate of return, right? Very simple math here. This is like, junior high math, okay? Just simple division. You have your ending value, okay, minus beginning value, okay, plus any income over the beginning value will give you your return, your rate of return in terms of percentage, okay? So let's say the beginning value of our asset was 100, so 100 would go down the bottom here, and the ending value was 105, okay? So on top we'd have 105 minus 100, okay? So far we have a 5 up top. Let's say it paid interest or some kind of dividend payment or whatever, and there was $1 of income as well. So we'd add that dollar. So it would be 105 minus 100 plus $1, okay? So now we would have 6 over 100. 6 over 100 is what? 0.06, okay? AKA 6%. We'd have a 6% return there, okay? Rate of return calculation, that's something I could easily quiz you on. I could say $1 of income, $105 ending market value, $100 beginning market value, give me the rate of return in terms of percentage or just decimal places I would accept. Okay? This is again the same slide with just an example on it. Okay, rate of return. Okay. This is saying price. This is very common in investment management, especially textbook. Price at time 0. Time 0 is what? The beginning today. Then it's price at time 1 minus, ignore that box, price at time 0, ignore that box, and that's a plus any income. It's calling it dividend income here. So it shows you a little example here. End price 22. Beginning price 20, dividend income 1. Now this form, and then it breaks it down for you. It's saying that's a 15% rate of return. This can work negative too. I mean, you'll just come up with a negative number hypothetically if the ending price is less than the beginning price. Risk and return trade-offs. Uncertainty associated with incomes from an investment. The higher the risk, the higher the expected return. Expected return. Okay. Greater uncertainty displayed with wider dispersion. Higher variance and higher standard deviation. Okay. Additional investment risks. So we have tax risk, operating risk, financial risk, management risk. We'll get into all these things later. Tax risk. What would tax risk be? We'll talk about that. And this is all in your book. Let's say you're in this dividend investment. And tomorrow Congress goes into session and changes the dividends tax laws, and that adversely, affects your investment. Maybe they raise dividend taxes from 15% to 30%. So that would be a risk in the investment. Actual considerations of required returns, the real rate of return, the anticipated inflation factor, and the risk premium. This all has to do with something called the CAPM model, CAPM. Very important if you end up pursuing a career in finance. It's really a theoretical model. You'd be calculating CAPM in the workplace. It's very theoretical. It's not as practical. But you can use these inputs here to do some basic stock valuations. The problem is that, how accurate is it going to be? We'll get into that. Okay. The real rate of return is the return investors require for allowing others to use their money. Okay? So let's say my required rate of return is, 3%. And this rate is the annual percentage return realized on an investment before inflation and before consideration of risk. So let's say I was loaning money to my mother, right? And I'm still a loan shark, right? I'm loaning money to my mom, and I'm loaning her $100. And my mom says, Mike, I'm going to need 6 months to pay you back. And I'm like, well, my required rate of return, can you believe I'm charging my mother interest here? My required rate of return is, 2%, okay? And it's a 6-month loan, so it's basically 1%. We're dividing that in half. So, Mom, I consider you risk-free, and we're not including inflation here. because I'm a nice guy. So in 6 months, just pay me back $101, okay? Because that's my required rate of return before considering risk or inflation. Okay? Anticipated inflation factor. Okay? Now I say, oh, Mom, wait a second. I have to, I think there's going to be high inflation this year. Right? You probably can't see this year. Again, it's a formatting issue on the slides I'll fix for the next week. But let's say we expect inflation of 3%. Okay? I think I can move to the next slide. It'll give me a better calculation. Okay? Let's say we expect a inflation rate of 3%. In my required rate of return, oh, let me move back. Sorry, I think I might have screwed something up. Okay, I didn't. The real rate of return is also considered the required rate of return. So let's say my real required rate of return is 2%, and my anticipated rate of inflation is 3%. The real risk-free rate, as you can see right here in the very small letters, is, using the calculator, 1.03 multiplied by 1.02. My real risk-free rate, not considering risk now, we went from just doing the required rate of return to now incorporating inflation, is 0.0506. So that's what happens when you get 1.02 multiplied by 1.03, and then you subtract 1. This is a formula in your book, very straightforward. Should have to memorize this. Probably I will test on this. Okay, just keep that in mind. Okay, my risk-free return is 5.06. Okay. Now, risk premium. This is the third factor that we talked about. Is the premium that I require on top of my risk-free rate. Okay. So, return in excess of the risk-free rate to compensate for market risk. A higher rate of return is required to entice investors into a risky investment. Let's say I'm not loaning money to my mom anymore. I am loaning money to my third cousin's best friend. I have no association with this person, and I don't know what kind of character this person is. So let's say, you know what, this guy's a little risky. I have my risk-free rate of 5.06. But what's the risk on this person? Will they vanish? Or we can call this person a company or whoever. So I might say, all right, well, your required rate, I'm going to adjust my risk-free rate for the risk premium and add that up. So let's look how that works, okay? And we're going to do a calculation. This is all leading into the cap-end theory, okay? So the three components of total required rate of return is the real rate of return, okay, plus multiplied by inflationary expectations, which combine to provide the risk-free rate. Okay, these are common to all investments. Okay, the real rate of return plus inflationary expectations. Okay, then we have the risk premium, which is combined with the risk-free rate to provide the total required rate of return. And the risk premium is particular to every different investment. So, like I used the example with my mom or my third cousin's best friend, they're going to have a different risk associated with them. One is going to be virtually risk-free. The other one is going to have a high risk associated with it. Okay? And here it gets all summed up here. So, required rate of return using the capital asset pricing model. Okay? We have a beta. A beta is the return of a security relative to the market. It is the kind of risk factor, and I believe the formula for that is variance over covariance, but I won't go into that right now. Okay? If the beta is equal to 1, the security return is equal to the market return. So if a stock has a beta of 1, you would expect that if the market goes up by 1%, the stock would go up by 1%. Now, there's a formula for this on the next slide, which we'll go into. Now, if your beta is greater than 1, the security return is greater than the market. So in this case, if you have a higher beta, if the market goes up 1%, you would expect that the stock would increase by more than 1%. Now, this isn't a linear equation. It won't always work this way, but these are the expectations. If you have a beta of less than 1, security return is less than the market. And this is on positive and negative swings. So, a high beta stock might be something that's like a technology firm. You know, that like a startup technology firm, which, you know, may have a lot of risks associated with it. Now, a low beta stock is probably something like McDonald's or Walmart, you know, or a grocery store. It would be another good example of a low beta stock. Why? Because regardless of how the stock market returns, you're still going to go to the grocery store next week and probably buy the same stuff you bought the week before, right? As opposed to some fancy technology stock, you know, you might not buy PlayStation 4 if the economy starts doing poorly because you might not have the money. You know, it's more of a need than a want. Okay? Here's the cap on it. Here's how it works, okay? Risk-free rate goes here, okay? Multiplied by the beta times the equity risk premium, okay? So, we have a risk-free rate of 4.6. We have a beta of 1. The equity risk premium, right? The value associated with the individual risk for each stock is 4.4. So we add that, 4.6 plus 1, multiplied by 4.4. This is something, if I'm going to do a calculation, very generic, easy algebra here, I would give you the risk-free rate, the beta, and the equity risk premium, and I would tell you give me the answer. Very straightforward. I'll probably give you homework questions on this as well. Okay. Last slide here. Topics covered in the CFA exam. Coincidentally, the book mentions the CFA exam fairly often for reasons I described at the beginning of the slide. CFA exam covers many different topics. It's an extremely difficult exam. Has a 70% failure rate on each exam. Okay. There's 3 exams. The first one's given twice a year. The last 2 are given once a year. And a 70% fail rate means that if you pass, odds are every person sitting around you failed. If you're doing, you know, statistical analysis on that. So it goes into ethics and professional standards, tools and inputs for investment valuation and management, asset valuation, and portfolio management are all the major topics discussed in the text. It's about 2,000 pages of reading. It's a 6-hour exam. It's grueling. It's not fun. They say it requires about 300 hours of studying. They don't give you a class. It's all self-study. You can take a class on it. However, it is a self-study exam. So just wanted to wrap things up. If you have any questions about that, or wish me luck, by the time you watch this video, I will have taken level 2 of the CFA exam, which is this Saturday, June 2nd. So if you want to wish me luck or ask how I did, I won't know the results until late June, late July. Well, that was the end of the first class, first chapter anyway. Please don't hesitate to ask me any questions.